Dividend investing is a popular strategy, especially for those looking to generate income or to build a retirement portfolio. I often hear from potential clients, well, Brandon, what's the dividend of the stock or the fund? Or it pays a 7% dividend, so it must be a great stock. But is it really the best way to grow your wealth or to even generate income? In this video, I'll break down the pros and the cons of dividend investing to help provide clarity around a dividend-focused approach for retirement. Teaser here, the reality of a dividend-only strategy may shock you, and focusing on total returns may mean less tax, more flexibility, and potentially a larger portfolio over time. As always, the opinions expressed in this channel are for informational purposes only, and they're not intended as a recommendation to buy or sell any particular investment. This video is intended to provide education about different financial planning topics and should not be considered as financial, legal, or tax advice. And as always, please consult your financial advisor, accountant, or attorney before making any investment or financial decisions. And of course, please remember that past performance is no guarantee of future results. Good old dividends, the golden ticket to retirement income, right? Well, let's dive a bit deeper first. So I was meeting with a potential client a few weeks ago, and this person, I'll call her Sally, kept pointing out dividends any chance that she could get, which really sparked the idea for creating this video because I do believe that there's a common misconception among investors around dividends. Sally, just like a lot of investors out there, know mostly the positive of dividends, but not really the negatives. And in my opinion, dividends can be an excellent addition to an investment, but focusing primarily or too much on dividends can be an issue long term. So let's first start with what is a dividend. So a dividend is a payment made by a company to its shareholders from its profits. It's usually paid out quarterly, and in order to receive the dividend, you have to purchase the stock before its ex-dividend date. That's an important date to know. Essentially, a dividend represents a portion of the company's earnings that it chooses to distribute rather than to reinvest in the business. Dividends usually mean that the company is profitable, and instead of reinvesting those profits back into the company, they kick those profits out to shareholders. And of course, that can make shareholders very happy. Even John D. Rockefeller, the oil tycoon and master investor, famously said, "Do you know the only thing that gives me pleasure? It's the dividends that I see coming in." Now, hopefully that wasn't the only thing that was giving him pleasure in life, but the point is, one of the most successful people in history saw the benefits of dividends. Another note, companies that pay a dividend usually have been around for years and potentially focus a little less on growth initiatives, and in turn, these same companies probably have enough cash flow to generate profits consistently. Now, I can hear some of you saying, well, Brandon, that's not always true, and you're right. So on the flip side, Berkshire Hathaway, led by another powerhouse investor, Warren Buffett, also known as the Oracle of Omaha, doesn't really believe in paying out a dividend to Berkshire shareholders. If we look back at the history of the stock, the company hasn't paid a dividend in nearly 60 years, and it certainly could have paid a dividend to shareholders for probably most of, if not all of those years, given how profitable of a company it was and still is. However, instead of paying a dividend to shareholders, they reinvested those dividends back into the company for innovation and to continue to grow and to even acquire more companies like Apple and American Express. And based on the returns of Berkshire stock over the years, it certainly paid off. Traditionally, companies that are trying to aggressively grow typically don't pay out a dividend. But more recently, companies like Meta, formerly known as Facebook, and Alphabet, also known as Google, each pay a dividend, even though they're still really focused on growing significantly, especially with an AI race occurring among the largest tech companies. Even Nvidia stock, the current AI leader in my opinion, pays a whopping 0.029% dividend as of making this video. Thanks, Nvidia. But of course, these companies are still trying to grow and aggressively at that, but they're also not in the early innings either, like they were 10 to 15 years ago, hence the ability to now pay dividends. Point being though, dividends are often seen as a reward for investing, providing income regardless of stock price movement. However, dividends are not always created equal, and understanding how they fit into your overall financial plan is key. While stock market gains are often volatile and hard to predict, dividends can compound over time to steadily grow an investor's wealth. Once you enter retirement, I always talk about this, you're typically in your distribution phase of life rather than that wealth accumulation phase. That means that you're most likely looking for income strategies rather than exponentially growing your wealth like you were in your 30s and potentially 40s. Dividend stocks can provide a somewhat reliable, regular income stream similar to other investments like real estate or bonds. Also, dividend investing offers a more subtle advantage. Dividend stocks tend to be less volatile than other stocks like growth-oriented stocks. And this is because the market rewards companies with the earnings power and the cash flow, as Mr. Wonderful says, to sustain dividends. And as a result, dividend stocks tend to trade within a well-defined historical range, displaying more stability compared to non-dividend paying stocks, which can wildly fluctuate based on momentum and other non-fundamental factors. However, we often find that dividend stocks tend to be more volatile than, let's say, fixed income investments like government bonds. So focusing on fixed income within your portfolio to mitigate volatility and to also generate income may be the more optimal outcome. Another benefit of dividend stocks is that it can propel the element of compound interest, also known as the eighth wonder of the world, according to Einstein. A simple rule known as the rule of 72 illustrates the compounding effect, and it really is quite simple, which is why I love it. The rule of 72 says that if you divide 72 by an interest rate per period, you should expect to double your money in that amount of time. For example, a stock yielding 8% will double an investment every 9 years through dividend reinvestment alone, not accounting for any fluctuations in price, of course. This can be extra valuable during uncertain times when savings accounts offer meager returns or when growth stocks are experiencing greater volatility over longer stretches of time. Based on everything you just heard, you may be thinking, dividend strategies sound great. What's the catch? And before you think dividend strategies are the only way to go, let's pump the brakes and point out the reality, or dare I say, the cons of dividends. Just because a stock pays a dividend doesn't mean it's the best choice for generating cash flows in retirement. Like I mentioned earlier, we often come across potential clients that look at high-yield dividend stocks or even dividend funds, and they believe that's a great investment because of only the dividend yield. Just because the dividend yield is high does not mean that the stock price has performed well over long periods of time. Potentially the exact opposite. Also, exceptionally high yielding dividend stocks may seem appealing, but they often carry outsized risk of a dividend reduction, even with dividend growers. These ultra high yield securities with a high risk of cutting their dividend payments are also known as dividend traps. Investors have to do their due diligence to understand the true nature of a company's stock yield. Yield is a fraction dependent on both the dividend and the stock price. So a dividend may appear incredibly high even though it's about to be reduced. For example, if a company's dividend is $1 and the share price is $50, the initial yield would be 2%. Not particularly attractive for a dividend-focused strategy. However, if the stock price drops to $10, the yield would then be 10%, potentially luring in those yield-hungry investors. In this case, it's clear the company did not intend to pay out a dividend 5 times higher than originally expected. If there's no compelling reason for the share price to rise back to $50, the company will likely significantly reduce the dividend on the next ex-dividend date, making the investment far less lucrative. Also, and this one is often overlooked, you want to be careful for what types of accounts you are placing dividend stocks into. For example, if you place dividend stocks in a retirement account, like an IRA or a Roth IRA, you don't have to worry about the taxation on the income from the dividends. However, if you place those stocks in a taxable brokerage account, which is a great account to have in retirement as well, the income from dividends will be taxable. Dividend income may be taxed at a higher rate depending on your tax bracket and also the type of dividend. So there are two types of dividends: a qualified dividend, which gets a long-term capital gain tax treatment, and then non-qualified dividends, which can get taxed as ordinary income, so all the way up to 37%. We discussed earlier how dividend stocks can potentially be less volatile than growth stocks, which can be good, but that can also be a negative. And why do I say that? Well, dividend stocks tend to have less exposure to high growth tech stocks, potentially limiting long-term capital appreciation. Growth stocks, especially over the past 15 years, have been driven by tech names and have provided exceptional returns. A lot of dividend-focused mutual funds minimize or leave out tech entirely, but over long periods of time, they have proven tech stocks to provide significant growth. Let me ask you this: do you think that technology is going anywhere? Seems unlikely. But of course, past performance is no guarantee of future results. So let's use a brief example: AT&T stock. And for some reason, I always feel like that stock gets mentioned when discussing dividends, and for good reason, because it does pay a high historical dividend yield. And as of late, the stock has been trending higher and performance was really good in 2024. But if you take a step back and you look at the total return, which is capital appreciation and dividends, it tells a different story. AT&T's stock, also known as its ticker of T, its total return over 5 years or even 10 years has been substantially lower than its benchmark, the S&P 500. So this highlights the risk of focusing too much on dividends and not enough on total return. This is not to beat up on AT&T stock. There are many other high-yielding dividend names similar to AT&T that have lagged the broad market for years if you dig deeper and look at the total return. Finally, let's take a look at several dividend ETFs or mutual funds compared to the SPDR S&P 500 ETF, also known as SPY. As you can see, from January 1st, 2009 to December 31st, 2004, roughly 15 years, all of the dividend funds on the chart have underperformed the S&P 500. Now, I'm sure there are certain dividend-focused funds that have outperformed the market during this same period, but as a whole, a lot of them have underperformed the total returns of a fund like the S&P 500 over that time frame. Now, based on the list of funds on the chart, the Fidelity Dividend Growth Fund came in second place with about a 700% return compared to SPY at about 770%. Not bad. However, the fees over that same time period withered away at the performance, not to mention stocks like Nvidia, Amazon, Netflix, and even Tesla have performed exceptionally well during those periods, and dividend funds typically have less exposure to those high beta growth stocks when compared to a market capitalization weighted index like the S&P 500. While dividends provide income and stability, focusing solely on dividends can lead to lower long-term returns. A balanced strategy that includes both dividend stocks and growth investments is often the best approach in our opinion. Also, if you are looking for steady income, like I mentioned earlier, having a portion of your portfolio designed specifically for income is usually the most optimal way to generate income in retirement, and you can do this by owning fixed income investments like bonds. Point being, I've said this before and I'll say it again, a well-diversified portfolio should include a mix of asset classes. When it comes to stocks, consider both income-generating assets and growth investments. At the Clark Group, we like to take a balanced approach and believe that focusing on total returns when selecting stocks or even funds is more advantageous for retirees in the long run rather than relying solely on dividend strategies. Index funds, which typically have a blend of dividend-paying and non-dividend or growth stocks, are often low cost to own and have demonstrated long-term performance, even if they experience slightly higher volatility than pure dividend funds. So crafting an effective retirement distribution strategy is crucial as each person's needs are very unique. Our goal is to develop a retirement plan and portfolio that can withstand withdrawals during both good and bad market and economic conditions. As always, you want to consider your risk tolerance, your goals, and overall investment strategy before committing to any type of investment style, whether that be value, growth, dividend, or Nancy Pelosi's stock tracker. You want to make sure that you're doing your due diligence. So, are you thinking about incorporating dividend stocks into your portfolio? Well, let's create a strategy that works for your long-term goals. You can schedule a call with our team using the link in the description, and make sure to subscribe to this channel for more content like this in the future.